That doesn't sound so good.
Kind of a creative solution. It's horrible, stay away, they're vultures, no dilution. We'll get back to that.
Yeah. So imagine that you are having a high growth startup and you need money and you need it now. What do you do in this situation? Equity financing? Maybe not. Regular or traditional bank loans? No. But what happens if venture lending comes knocking at your door? Imagine no immediate dilution in the company and you get the money. But is it really risk-free and as good as it sounds? We don't know. But today, Kat, our business lawyer, is going to break down the venture lending for us.
Yep.
So you know how to take advantage of that and when you can use it and when you should run the other way. Kat, welcome.
Tack. Hi. Well, let's start directly.
Yeah, it seems like a big thing. We need to go through it all.
Yeah, and it's not as... you don't know about it as much as you do about venture firms, venture investing, right?
Exactly.
Yeah.
I never heard of it.
No. So this is a loan, high risk loan.
And why do you use that instead of other things?
Yeah, it's so fun because if you be careful, if you Google it, you'll find all of these bank and other institutions offering venture debt, preaching to the choir why it's so brilliant. With, like you said, no dilution. We'll get back to that.
Yeah.
And why it's so attractive for you and how they support startup ecosystem.
Yeah.
Or you look the other way and you find those who only badmouth it and say it's horrible, stay away, they're vultures, etc.
That's why we have you to like break it down so you can take your own decision.
Yeah, I've been in many negotiations with venture lenders. So to kick it off, difference between a bank loan and a venture loan is that if you can take a bank loan, you take a bank loan.
Yep.
If you're a startup, you can't take an ordinary bank loan because you don't have the security, the assets, or the stability, the profitability, etc. So that's off the market. This is higher interest rate, shorter duration, typically 3 to 5 years. They often want a kicker. A kicker will be that they will want some kind of equity in your company. Typically warrants, so not direct dilution, but some smaller future dilution.
So if I lend you money, I want something back.
Well,
in
addition for, you want the money back, of course, and you want the interest.
But something
also,
extra.
Yeah.
Okay.
Yeah, so it's a kind of a creative solution. And what also is good to know here is that given that it's, equity, you can always kind of find out how the structure is set up. You can look at how different venture capital firm works. Venture lending, that's a bit more under the radar, and the contracts are held private. It can be hard to know what's market practice and not, and what's reasonable and not, and how far the lender can push these conditions. And they will have covenants. Super important.
Yes, and what is that?
Because also, if you can, some say, oh, you need that. This is what, because you don't want dilution.
No, of course not.
Yeah, but most often it's because you cannot get an investor. Most often, not always, but often. Can be a strategic, brilliant choice in some instances. But in this case, where you're a bit desperate for cash, they will have covenants, which they are typically very, very far-reaching. They can be positive and negative. That means that they want to say so if you want to change your business plan, if you want to make other, take up loans. At least you cannot take any loan that will be senior to their loan, etc. And they will typically be very, very far-reaching. And if you do not adhere to them, you will need to try to negotiate with the lender, or you will default on the loan. Yeah. So that's a big one. High interest rate, covenants, short duration. And also, when we talk about the high interest rate, do look at the totality. Because there can be very many costs in different layers. So it can be a penalty fee in certain, if you want to pay back early. It can be a fee for the drawdown, taking the loan, etc., etc., etc. So they can be, and sometimes you have an interest holiday. So you do not pay interest in the beginning, but it will be compounded. So you will pay that finally. And that is also, it's a high risk for you if you're not profitable yet. I mean, if you get equity, an equity holder has nothing to say until you are profitable. He cannot say, I want my money back from the company, right? A shareholder stands the risk, whatever happens with the company. A loan provider does not have that same second tier standing. They will demand the interest and the payment back, which means that your startup is much more vulnerable financially as soon as you take up debt, right?
Yes, of course.
Yeah. So more risky to have debt than to bring on investors. And then we did mention it can be good.
Yes, it can be good. But in what situations?
Yeah. So often it comes when you have a VC. A venture lender would not go to give money to a startup that's not VC backed. But let's say that you are scaling fantastically and you did a Series A funding round here, and you do not want to make a new funding round here because the valuation is okay. But you know that in 12 months your valuation will be here. Then you can have it as a kind of bridge financing.
Okay.
Kind of a leverage financing, really, because if you take on loan, debt, and you have a prolonged runway for, say, 12 months, then that can be a super strategic move for you if you feel assured that your valuation will be that much higher. Because, again, it's leverage finance. So in some instances. But again, also know that one additional downside with venture debt will be that you may be much less attractive for an investor going forward. Because say that you took a venture loan for 5 million with a duration of 3 years. After 3 years, you come to me and say, well, I want an investment of 7 million. And I look and I say, but okay, but 5 of my millions will not go to the company. They will go to pay back a lender. Why on earth would I go with you? And that's just, I'm giving my money away to somebody who's walking away. It won't help the company. So you might come in a situation where you are less attractive. Because remember, the debt, the lender, will always be prioritized also in front of VC that has preferred shares.
Yes.
So, dangerous.
Yeah, but it feels quite risky to have the short terms. I mean, you have very short time to the company have to grow fast and get money.
Yeah, that's aggressive loan terms.
So you need to be quite bold to do that, right?
Right, absolutely. Or desperate.
Oh, desperate. Yeah. Well, you're quite bold sometimes when you're desperate
exactly.
too.
But like I said, sometimes when you want to postpone the next funding round, it could even be that your VC backers are positive to doing a bridge kind of venture lending finance.
It could be a good start to just to get moving.
Yeah,
Wow.
to leverage it.
So that's venture lending.
Yeah.
Is there anything more we need to know about that?
Well, I think as regards the covenants, also know that there is typically a cash requirement, which means that if you bring in a VC investor, a VC lender, and you have a pot of 12 million, there might be a covenant saying that you need to have 4 million in cash in bank, so you can't use it.
That doesn't sound so good.
No. So just know that the covenants are far-reaching. Read them through, know what costs and the consequences, because if you default, many venture lenders will have a right to take over the company. Now, they don't want that. They're not in the industry of taking over companies, but they are very rigid. They're hard to negotiate when you're in trouble. So be mindful, read the fine print, because there is a huge variety in the terms and conditions of a venture loan. Very, very big variety.
Yeah, so now you know that for taking out venture lending, read it through carefully and know what you're getting yourself into.
I would say get legal advice, get financial advice.
Yeah.
Because this is
not legal advice. It's knowledge sharing.
Yeah. strongly recommend getting good advice before you decide to go with venture lending.
Really good tip. And now you know about this. Thank you so much for watching this episode. This episode is powered by LE Fitness.
Hej då!
Hej då!